You just walked out to your mailbox after a 12-hour shift, opened a thick envelope from a lawyer, and your stomach drops. The paperwork says someone is suing you for $50,000 because of a car wreck. You've auto insurance, and you pay your premiums every month. But your policy limit, meaning the absolute maximum amount your insurance company will pay for this accident, is only $25,000. The person suing you wants double that. You're doing the math, looking at your bank account, and wondering if they can come take your house or garnish your wages, meaning legally skim money right off your paycheck before it ever hits your hands. When you get sued for way more than your insurance covers, you essentially have two main roads you can travel down to protect yourself. It's a head-to-head comparison. Option 1 is accepting a stipulated judgment. Option 2 is pushing for a full policy limit settlement. We're going to break down both of these options on the exact factors that actually decide whether you survive this financially or end up paying out of your own pocket for years. First, let's talk about option 1, which is called accepting a stipulated judgment. A stipulated judgment is a formal, legally binding agreement where you admit fault. The person suing you gets a massive paper judgment saying you owe them a ton of money, but they agree not to actually collect that money from you as long as your insurance company pays them the policy limits. Let's say the wreck was absolutely your fault. You ran a red light and hit a brand new truck. The driver of that truck needed surgery and missed 3 months of work. They're suing you for $100,000. Your insurance only covers $25,000. The other driver's lawyer might send a letter offering a stipulated judgment. You agree that you legally owe them $100,000, but they agree to accept the $25,000 from your insurance to satisfy the deal. They can't come after your personal bank account, your truck, or your paycheck. Why on earth would the other side agree to this? Why wouldn't they just take you to court, win the full amount, and take your house? Because collecting money from an ordinary person is incredibly difficult and expensive. Lawyers call this being execution proof. It means even if they win a $100,000 judgment, you don't have $100,000 sitting in cash. They can't squeeze blood from a turnip. A stipulated judgment guarantees they get the insurance money fast without spending another year fighting in court. There's a massive hidden danger here, and it's called the bankruptcy exception. When someone agrees to a stipulated judgment, the paperwork usually includes a specific sentence. That sentence says the judgment survives even if you file for bankruptcy. Bankruptcy is a legal process that wipes out most of your debts, but it doesn't wipe out debts you created through intentional fraud or certain legal settlements. If you sign a stipulated judgment with that magic sentence and you hit rock bottom financially 2 years from now, you can't discharge that debt. You're trapped forever. Plus, a massive judgment drops your credit score through the floor. Now let's look at option 2, pushing for a full policy limit settlement. This is exactly what it sounds like. You demand that your own insurance company just hand over the full $25,000 to the other side, so the other side drops the case entirely and walks away. You don't owe them a dime beyond the insurance money. There's no massive paper judgment hanging over your head. How do you make this happen? You've to prove your insurance company is acting in bad faith. Bad faith is a legal term describing a situation where your insurance company fails to settle a clear case when they easily could have, and their failure exposes you to personal financial ruin. Here's how it plays out. The other driver sends a settlement letter to your insurance company. They say, "We've the medical records and the police report. It's clearly your guy's fault. We'll accept the $25,000 policy limit right now to close the case." Your insurance adjuster reads the letter. They decide to play hardball. If you own a home with significant equity, meaning the house is worth way more than you owe the bank for it, and you've a steady job, you're a prime target. Equity is the actual cash value you hold in a property. In many states, the law allows creditors to force a sale of your house to pay off a court judgment. Because creditors can force a sale of your house, you can't just accept a massive paper judgment and hope they forget about it. If you've a steady paycheck, they can legally garnish your wages. In some states, they can take up to 25% of your net income. If you've assets to lose, option 1 is extremely dangerous unless you've an ironclad guarantee. You need to have a lawyer read every single word before you sign anything that admits you owe a massive debt. But if you rent your apartment, drive an older car that's paid off, and you're between jobs, you might have zero assets to protect. Creditors can't take something you don't have. In that specific scenario, a stipulated judgment might be the fastest way out. You still get the financial protection, but you don't spend a year fighting a bad faith battle against a massive insurance corporation for assets you don't even own. There's another massive piece of this puzzle. It involves something called an excess letter. An excess letter is a formal warning document your insurance company mails you. They say the demand from the other side exceeds your policy limits. They warn you that you might be personally responsible for the remainder. The letter tells you that you've the right to hire your own private attorney to protect your personal assets. Insurance companies send these to cover their own backsides. But here's the secret. Your insurance company is legally required to act in your best interest. They have a duty to protect your personal assets by settling the claim if they possibly can. If they send you an excess letter but refuse to pay the policy limits to settle a clear case, they're hanging you out to dry. Never just ignore an excess letter. It's the clearest sign your insurance company is preparing to sacrifice your wallet to save themselves a few bucks. This is exactly when you escalate the fight. You tell them they need to pay the limit before their stubbornness triggers a bad faith lawsuit. You force their hand so they pay the settlement and close the file entirely. If you're sitting there wondering when you actually need to bring a professional into this mess, the answer is right now. When a lawsuit crosses your policy limit, the insurance company's goals and your goals split in two. They want to save money. You want to keep your savings account. The insurance company will assign an adjuster and a lawyer to the case. That lawyer represents you in name, but their paycheck comes from the insurance company. They don't care if you lose your house in a judgment. You need your own personal attorney to review every offer. You need someone to read the stipulated judgment paperwork to ensure the bankruptcy clause isn't hidden inside the fine print. You need someone to fire off a bad faith threat to the insurance adjuster to force them to pay the policy limits. You shouldn't navigate a legal minefield where the blast radius hits your future paychecks. A local attorney who knows your state's specific exemption laws can tell you immediately if your wages and home are truly on the line. When you get sued for more than your insurance covers, it feels like the walls are closing in. The stack of paperwork looks terrifying. The numbers on the page seem impossible. But remember that the legal system has built-in pressure valves for exactly this situation. You've options. You can use a stipulated judgment to force a quick resolution when you don't have assets to lose. Or you can use the threat of a bad faith lawsuit to force your insurance company to pay the full amount they owe. You aren't powerless. You just need to understand the mechanics of the system. If you were ever sued for a massive amount of money that completely exceeded your insurance limits, which path would you personally trust more? Signing a paper judgment with the other driver, or fighting your own insurance company to step up and pay? Tell me your thoughts down in the comments. If this breakdown helped you understand exactly how to handle a terrifying lawsuit that threatens to drain your bank account, pass this video along to a coworker who might be stressing over an accident right now. Make sure you subscribe to Scribble Law so you always know the actual rules of the game before the legal system tries to blindside your wallet.